Welcome back. Let's spend a few minutes and think about an idea known as the efficient markets hypothesis. So what is the efficient markets hypothesis? So efficient markets hypothesis. So this is a suggestion that asset prices, like stock prices for example, incorporate publicly available information, and as soon as new news is released, it gets priced into the stock price. So the efficient markets hypothesis is the idea that asset prices reflect all publicly available data. So all publicly available data and news. So let's look at an example. Let's think about Apple's stock price. So if we think about Apple's stock price as an example, and we think about an event. So let's suppose Apple releases a new iPhone. So they have their Apple publicity event and they release this new iPhone and they say coming soon. Haven't sold any of them yet, but have just announced it, talked about it. Whatever the upgrades are, probably a better processor, nicer camera, clearer screen, etc. So let's assume that Apple releases a new iPhone and critically that markets think this is going to be one of these better selling phones. Right? Some releases you're like, whatever, it's the same as the last one, but some of them grab a lot of attention. So let's say that markets think that the new phone is a positive big deal. So markets think this thing is going to be sweet. Pundits are talking about it. Oh, this phone is going to be great. All right, what happens to Apple's stock price and why? So we can think about this in the context of a supply and demand model. We can use our three-step process to think about it. So our first step was which curve shifts? Well, this is going to be a story about demand, but it's also going to be a story about supply. So we've got demand and supply shifting. Second step, which direction do they shift? Well, demand for Apple stock will increase, right? People who are thinking about investing in the company, thinking about buying Apple stocks, say, sweet, they released a new phone. This should sell a whole lot. That should be more profits in the future. Now I want to buy that stock. So demand for the stock is going to increase. But at the same time, folks who already own the stock are going to see the same news. And they're going to say, wow, this new phone's going to be great. Maybe I'll hold on to my Apple stock. Right? So the supply of Apple stock available for purchase is going to decrease as well. So what's driving this? The increase in demand and the decrease in supply is a story about buyer and seller expectations. Right? Buyers and sellers' expectations of the future. Remember, Apple hasn't sold any of these phones yet, but buyer and seller expectations of the future sales are driving their behaviors today. That's really this efficient markets hypothesis, is it's just price responding to a change in expectations. What changes expectations? Publicly available news, etc. All right, and then our third step is we want to draw and see. So what happens? So since we have two curves moving, we need two supply and demand diagrams. So we've got price, quantity, throwing a supply curve into each one. Supply, demand. And we start out with some initial price and some initial quantity. So what happens is demand shifts to the right. People are jazzed about these new phones and they think that Apple's going to sell a whole bunch of them. That's going to drive up the price of Apple stock as people try to purchase the stock, right? So as they come to the market and want to buy, that should put upward pressure on price as well as increase quantity. But what about this supply decrease? The folks that have Apple stock, right? They're the ones that could sell it. They're the ones that these buyers have to buy it from. Well, their expectations are changing as well. And they're saying, oh no, there's this awesome new phone coming out. I ain't selling. I'm going to hold on to my stock. So the supply of stock available for purchase decreases. So what does that do? That makes it harder to purchase the stock, reduces the quantity, which also puts upward pressure on prices. So in this case, what's our net effect? So if we're thinking about price, we have an increase in price plus an increase in price means that price is increasing. And what about quantity? Well, you've got an increase in quantity plus a decrease in quantity leads us to this ambiguous result. So we're not quite sure what's going to happen with the quantity of stock. In financial terms, you would refer to this as volume. But we can say if Apple releases a sweet new phone, its stock price is going to go up, driven by the expectations of buyers and sellers being priced in. That's the efficient markets hypothesis. Thank you, and we'll see you next time.